Well, it wasn't a pretty day on the local markets either today. For his take, I spoke to David Halliday from Macquarie Bank. David Halliday, the statement from the US Federal Reserve unsettled the market, but would you have expected a sharp decline?
Certainly not to the magnitude we saw today, Ticky, 85 odd points, and certainly the worst day of the market's seen for about 2 weeks. Wasn't what was expected. You know, the Federal Reserve didn't move rates. That's no surprise. It's pretty hard to move them when they're already at zero. We were looking for the quantitative easing number, and whilst it was smaller in terms of the magnitude of bonds that the Federal Reserve decided to buy, it was still a significant effort. I think what the real drag was the commentary about the US economy. The Reserve stated that the pace of the economic recovery there was going to be more modest than they previously thought, and I think that served to give the market a bit of a shake early. Throughout the course of the day we had some corporate results out, and they were certainly below expectations and worse than expected. That took a little bit more off the market, and obviously the resources also had a very bad day. Commodity prices were weaker overnight, and again there's economic uncertainty about China, so all those things coalesced and led to what was really a pretty bad day overall.
So did we see a retreat into defensive stocks?
No, we didn't, unfortunately. It really appeared today that money was coming out of the market. If I looked across the board today, there wasn't one sector that was up. So for me, that's a pretty strong indication that there wasn't money being rotated from cyclicals to defensives or even any other part of the market for that matter. In speaking to a few professional investors, it does appear they've got a bit of concern about which way the market is going from here, and normally in those circumstances, money tends to come out and sit on the sidelines until we get a clearer picture of which way it's going to go. So not a rotation, just a withdrawal of money, it seemed today.
The finance sector was a bit of a drag. Was everyone taking their cue from the Commonwealth Bank?
Indeed they were. The result in headline figures wasn't too bad, but the thing that really got the market was the wholesale funding costs that banks are now facing, and we saw it come through in the NAB trading update just a couple of days ago. The net interest margin line for CBA in their result today was certainly a bit disappointing and concerning. Questions now whether the banks as a whole will need to raise their lending costs above the Reserve Bank rate. Even if the Reserve Bank doesn't make a move, there's a chance banks may have to lift their rates, and obviously that has a flow-on effect to lending growth in the consumer sector and the business sector, and that impacts margins. So it's really about wholesale funding costs and the impact that's having on margins. People are quite concerned about that, and as a result, all the banks sold down today. We'll get some more information from ANZ and Westpac on the 20th and 23rd of August, respectively. But in the meantime, I think uncertainty prevails.
David Halliday, thanks for talking to Late Line Business.
Thank you.